Well, joining us now, Eugene Goosen from Ora Fund. He joins us for more investment insight, and we're going to be particularly focusing on a couple of stocks, starting with the micro lenders. And you'll be aware of a news flow out today from Capitec, the bank out with a trading update this afternoon. The company expecting full-year headline earnings per share to be as much as 50% higher. The group shares ended just over 0.5% lower on the day at 186 Rand 10 cents. Well, Eugene, it certainly looks as though all the good news is priced into Capitec's share at the moment.
Yeah, if you look at the earnings expectations on Capitec itself, it's fairly close to what the company is expecting. PE-wise, the share is not cheap, but they are producing growth, and they're delivering the results. I think competition in the market is going to be elevated to some extent. We can see a lot of people entering into the market. However, they've got a very good recipe, and I think for the next 3-4 years they will grow very aggressively. Even though they've got a good recipe, would you be buying the stock at these heady levels at that 186 Rand? No, I never owned any Capitec shares, and I'm very humble when I say that. And at these kind of valuation metrics, it's not our style to buy shares, such growth-orientated shares at these kind of valuation levels. So it is too rich to me, and it surprises you every year. We like stable, high dividend yielding stock at low PEs preferably. Eugene, so, I think it's not the kind of style that we like, but it's a wonderful business. I think Nick Norman-Smith from Lentis Asset Management shares your sentiments on this one. You're not after the growth stocks either, are you?
No, Bronwyn, and we made the genius move of selling our Capitex, I think, at about 50 or 60 Rand. So you know, it wasn't the smartest move.
Gentlemen, it's good to share the war stories on the desk.
But Bronwyn, exactly, it's not our style. You're going to miss some of these. I mean, if we just look at Capitec now, it's on a price to book of around 5. That will probably come down because I'm sure they're growing their loan book rapidly. But that's not generally a recipe for great investment returns going forward. There are always going to be the exceptions, and I'd probably bank on Capitec more than anyone else given how well they've performed. But we're going to steer clear of those because, you know, on balance, you're going to do poorly from this kind of level.
Eugene, Abel could be a good recipe for great investment returns going forward. Do you agree?
Yeah, I like the company, I like their recipe. They are fairly successful in what they achieved, given the banking side. We weren't very keen on the retail venture that they took, but it looks as if they've turned that around, and that the synergies in that business are starting to come through, especially with all the kiosks and small branches that they opened up in the Ellerines and related stores. So I like the business. It pumps cash. It pays a very high dividend yield. It's not cheap, but I think it's priced reasonably. It has rallied to some extent over the past couple of weeks or month or so. But we like the business, and on the banking side, they know exactly how to manage credit. They know how to enter that market. It's a very good business model.
Yeah, Bronwyn, fantastic management team once again, know how to manage the risk. It's not super cheap, so it's cheaper than some of these others. If you're looking at that micro lending furniture kind of space, we think JD Group's more attractively valued than that. But we are pretty nervous about all retail exposed stocks, because we just think that sector is just, you know, it's on a peak for everything, and the valuations are pretty high. So we're a little bit scared there.
Let's talk AVI versus Tiger Brands. Eugene, thoughts on that front?
Yeah, we look at the two shares and we like them both for a reasonably attractive dividend yield, not a super dividend yield. Stable earnings defensive stocks. However, if you look at AVI, you sit with a very high quality portfolio, whereas if you look at Tiger Brands, it's very generic products. I mean, on the baking side and the milling side, they're doing exceptionally well, but their product mix is very generic. And the risk that you have here is that the retailers are going to become more and more aggressive in the way that they price, the way that they select their brands, and the way that the product is distributed. And I think AVI on that side is very well positioned with very strong brands, very strong management team, and I would say slightly superior company from that point of view, and making it slightly more defensive from the assault that I believe the retailers are going to have on this market over the next couple of years.
Eugene, I mean, comparing the two is fine, but on an absolute basis, are you not a little bit concerned in terms of the valuations? I mean, they're both trading around 5 times book, dividend yields of 3% and 16 to 17 earnings multiples on what are probably close, if not peak earnings.
Yeah, I think if we look at earnings and we look at forward Ps and we see them in the area of anything between 12.5 and 13.5 times earnings, it is not cheap. We expect dividends to come through 3.5, maybe 3.7%, which on our side is reasonably attractive. What we like is the ongoing defensive nature of this stock. So we are not going to buy it for huge re-rating. We are buying it for the cash flows, we are buying it for the defensive nature, and we are buying it as some sort of dividend sweetener compared to the index itself.